Well, welcome everyone to the Nelson Capital 2022 fall presentation, The Fed Tightens Screws on Inflation. Today, we're going to discuss the inflationary forces affecting the economy and what the Federal Reserve has done in response and what they have yet to do. But before we jump in, I want to first take a moment to introduce the Nelson Capital team. With us as panelists today, we have the Nelson Capital Partners, Brooks Nelson, Steve Philpott, Darcy Nelson Smoot, and I am Evan Nelson. Filling out our research team, we have Dr. Ann Oglesby, Chrissy Domingo, and Donald Horton. And our great support staff here with Marissa Wisniewski, Tiffany Garcia, and Kelly Bojo. So we will be taking questions today and answering them at the end of the presentation. Feel free to pose them throughout the presentation by pressing the Q&A box at the bottom of your meeting controls. And with no further ado, I'd like to pass it off to Darcy Nelson Smoot.
Great, thank you, Evan. And thank you all for joining us remotely. We start off with the asset class returns. We do this on a regular basis and look at it quarterly. And this year has been ugly. The gold bars are showing the third quarter returns for the various asset classes shown at the bottom. The dark blue bars are showing the year-to-date returns, and all of them are negative, unfortunately. The worst performing asset class, the NASDAQ composite, this is the technology heavy index. It's a lot of growth companies that are kind of high-flying tech stocks in this rising interest rate environment. Those have been the most challenged and are down over 30% year to date. International stocks, both emerging and developed, are down about 27 to 28% each. The all world index, which represents the global market cap of the entire globe, is down about 25%. US stocks, which are represented by the S&P 500, this is the benchmark for US large, excuse me, the benchmark for US large cap stocks is down about 24% as of the end of September. Small cap stocks fared a little bit better, but not by much. And then on the right-hand side, the Barclays Municipal and the Barclays Intermediate Government Credit. These are two bond indices. Now, traditionally, when bonds act as a safe haven, so when equity markets are down, we generally see bonds having positive returns as flows go out of equities and into bonds. That has not happened this year. So the bond indices are down 10 to 12% each. And in fact, this is the worst bond market we've seen in about 40 years. Drilling down into the sector returns, this is the sectors within the S&P 500. Energy stands out, not only because it's the only sector that is positive year to date, but it is quite positive at more than 30% increase in total return since the start of the year. Part of this is energy stocks kind of climbing out of a hole. So energy stocks during the depths of the pandemic were hurt the most. And the reason for that is that when the pandemic hit, demand for oil and therefore the price of oil fell off a cliff. Energy stocks were, I think, 2 years running the worst performing sector from 2020 and 2021. But this year they've bounced back partly from the bottom. At the beginning of the year, when Russia invaded Ukraine, we also saw a pretty dramatic increase in the price of oil, which also helped energy stocks. The worst performing sectors, communication services and information technology, these are, again, those high flying sectors that tend to trade with higher valuations. Those have really been challenged this year. What the sectors that have actually held up relatively well, utilities, consumer staples, and healthcare, they're still down, but they're down less than some of the other sectors. And it's because these are really defensive sectors. What that means is, right now we're in a period of very high inflation. Consumers are feeling pinched by this high inflation. Discretionary categories are things that consumers are not really willing and able to spend on right now, but they're still probably going to pay their utility bill. They still need to go to the grocery store and buy food, and they still need to get the healthcare necessary. So those defensive sectors have really held up better, even though consumers are not feeling particularly flush with cash right now. So we look at the difference between growth and value, and I've kind of alluded to this, but to paint a picture and look at a year-to-date return. So first of all, what is growth and value? What does that mean? Growth stocks are stocks that trade basically based on expectations of future growth. They tend to be relatively new companies that are growing really quickly. They don't really need to pay a dividend because shareholders that buy those shares of those companies are happy with the high growth that they are churning out. Value stocks tend to be more established companies that are kind of past their peak growth years. So they pay a dividend to kind of make up for the fact that they're no longer growing as fast as they used to. Value stocks also tend to have lower valuations, which makes them more insulated in periods of a valuation contraction like we're seeing right now. So value stocks are down about 15% year to date, which is less than half the declines we've seen in the growth stocks represented by the Vanguard Growth ETF on this chart. So, okay, we are now in a bear market. A bear market is defined as a peak to trough decline of at least 20%. The S&P is down 24%. We're solidly in bear market territory. So not surprisingly, we've gotten plenty of questions along the lines of how much worse can it get, or where is the bottom? And I truly wish I had the crystal ball to answer that question with any kind of certainty, but unfortunately I don't. So what we put together on this slide is a compilation of the historical bear markets that we've seen since the end of World War II, just to kind of handicap this and say, where are we versus where have past bear markets gone? So looking back to that time frame, if you average the decline, and this is again the tippy top of the market to the very, very bottom in each of these cycles. So looking at those returns, the average bear market return is negative 34%. So does this mean we have 10% more to go? I don't know. We could. It does. We don't actually know because we can't. We don't have that crystal ball. But if we look at the most recent bear markets that we've all experienced, 2020 with the pandemic, a 34% decline. 2007, 2008 was the great financial crisis. This was a systematic breakdown due to over leverage nearly everywhere in the financial markets. And 2000 was not only the implosion of the dot-com bubble valuation bursting, but it also was compounded by 9/11. So those recent bear markets are particularly bad, looking at the downside there. They're also kind of special. They have their own idiosyncratic pieces to them that really don't line up with what we're experiencing right now. I think what we're experiencing right now is more of a run-of-the-mill bear market. We have a bear market because the Federal Reserve is raising interest rates to battle inflation. So I didn't want to tweak the data, but you could arguably say those three recent bear markets are really kind of unusual. And if you took them out, the average return wouldn't be quite as bad as 34%. So taking all of this together, knowing that we are in kind of a common bear market, we think that we are closer to the bottom than we are to the top. So right now, the market is really focused on the Fed and inflation and what the Fed is going to do about inflation, rightfully so. We've had a lot of volatility in the markets, and that's because we get a better than expected inflation report, followed by a worse than expected inflation report. The Fed might say something, and then another Fed official might say something differently. And each of these events is moving the market really, really dramatically in larger swings than we've seen in the past. But at the end of the day, really the only thing that matters is earnings. So looking at earnings growth, this chart is showing earnings growth year over year going back about 10 years. The light blue bars are actually including the forward 3 years using analyst estimates. we kind of have to throw out 2020 and 2021 because it was such an erratic time period with earnings growth. But looking ahead, it's looking like we might return to a more normal, healthy period of earnings growth. Now, these analysts don't have crystal balls either, but they are putting these estimates out, incorporating the fact that the Fed has risen rates very aggressively and plans to continue to increase rates. And so that's now built into those analyst estimates. So this chart really does give us some confidence looking ahead. The other metric that we look at is the valuation of the equity market. So are equities relatively cheap or relatively expensive relative to historical time periods? So we use the price to earnings ratio, and in this case, we're using forward-looking price to earnings going back to 1990. So earlier last year, we made the comment that valuations were kind of rivaling the levels seen during the dot-com bubble, which is, it's true. We didn't get all the way up there, but we got pretty close. And that really was driven by two things. One is earnings fell precipitously during the pandemic. So the E in the denominator fell very quickly. That kind of artificially inflated the price to earnings ratio. But at the same time, the market was up a lot. So we saw that 34% decline. So in the depths of the pandemic, March of 2020, the market was down 34%. By the end of 2020, so by New Year's Eve on 2020, the market had actually increased and was up 18%. And I wish I could see everyone's surprise on their faces, because I'm surprised every time I look at that. But that was followed by another 29% increase in the market in 2021. Fast forward to 2022, and we're in this bear market, and what it's done is taken the valuation down really significantly. So the price to earnings ratio is sitting now at about 15.2 times, which is lower than the 25-year average of about 16. So I think arguably equities are relatively cheap at this point. I'm going to pass it over to Brooks, who's going to go through some of the economic data that we're looking at very closely.
Thanks, Darcy. So the Fed seems to be driving the market right now. What is the Fed concerned with? Well, inflation is number one. That's their primary mandate. They have two primary mandates: inflation and employment, keeping employment as full as possible. The recent inflation data that was released last week is showing that their efforts to tighten economic conditions are working. There was a slight downtick in the overall consumer price index to 8.26%. The core, however, actually increased a little bit. Core inflation factors out food and energy, which tend to be volatile. So the Fed has more work to do. I'm going to talk about the lagging nature of some of the components of the CPI. We think that inflation is actually further down than this number indicates. So the labor market. The upper chart shows the total US non-farm payrolls, which are reported at the first Friday of every month. And we see a really unusual scenario where we lost 20 million jobs in the month of April 2020. And then a rapid increase in non-farm payrolls as the worst of the pandemic started to be by us, and we were able to go back to restaurants and do some shopping. We've seen a steady increase since then, and we actually have non-farm payrolls today above the peak that existed before the pandemic. Well, why the rapid increase? Well, the demand for labor has increased even more quickly. US job openings, which fell during the pandemic, relatively quickly increased to the point where by a couple of months ago, we had more than 2 jobs available for every person who was unemployed. Most recently, the JOLTS data, JOLTS stands for job job openings and loss tracking survey showed a million job decrease in the number of US job openings. So we're starting to see labor conditions coming back into the direction of a more normal environment. Over the years, we have used the year-over-year growth in non-farm payrolls as a really, I think, a really good indicator of economic growth, but also of when we're likely to see a recession. On this chart, the light blue bars, which are kind of hard to see, are recession periods. And in every instance prior to this recession, assuming we are in a recession, in every instance, the minute that, or the month in which job growth declined below 1% year over year was almost always concurrent with the start of the recession. With the big drop in 2020, the subsequent increase, this data is no longer useful because it's been affected by the exogenous event of the pandemic. We are starting to see wage inflation moderating, with 2 jobs looking for every 1 worker who's likely to apply. Companies realized they had to offer higher wages to attract employees in those sectors that were most in need of them. And so we saw a relatively quick increase in wage inflation in late 21, and that continued into the beginnings of 2022. But since then, we started to see some moderation in wage inflation. One of the other really important things to look at is not just an unemployment rate, which is now back down to the sub 4% pre-pandemic level, but labor force participation. One of the biggest reasons that the job market is so tight is there are just fewer people who are working. Well, why did this occur? The pandemic hit. The job losses that occurred initially were largely service sector jobs and in hospitality and restaurants, bartenders, waiters, etc. And what happened concurrently in a lot of industries is baby boomers, my age demographic, decided enough of this. I'm ready to take time off and maybe go into retirement full time. And we've seen a lot of service sectors have been impacted by this, notably public accounting as an example. We have many clients who would like to maybe change an accountant and they can't find an accountant willing to work with them. And that's because so many of the senior accountants who are in their late 60s, early 70s have decided to call it quits. Working with the IRS has been a challenge. We've seen clients who have filed returns, paid their taxes, and then subsequently get a notice from the IRS that they're being done for interest and penalties for non-filing. It's been a lot frustrating and very frustrating. Also, what's further slowing things down is the rapid rise in interest rates. Not even a year ago, we were helping clients to refinance their mortgages at sub 3% levels. And today, those same clients, if they were to try to refinance today, would pay nearly 7%. That's having a very significant impact on housing. And you see that in this data here. And this is, I'm going to take a little bit of time with this because what you're seeing in the top 2 lines, the top one is the Zillow Observed Rent Index. We're seeing a decrease in the rental cost of apartments, condominiums, and homes. Similarly, the Case-Shiller Home Price Index is showing a decrease in the market value of homes for sale and the prices at which they are selling. Note at the bottom, the gold line is the shelter CPI. That's the component of the Consumer Price Index, which the government uses to measure home price impacts on inflation. It's rising. Why is it rising? The shelter CPI is basically a survey of homeowners, a select number of homeowners. Every 6 months, they ask, if you were to rent your house today, what do you think you would rent it for? It has a very significant lag to the actual rental and home prices. We've seen home prices in many markets around the Bay Area and nationally declining now 15, 20, or 25%. So when that comes into the shelter CPI component, which we think will be happening relatively quickly, we should see inflation dropping by probably a couple of percent just by the lag factor of this data. Similarly, inflation expectations are coming down. The blue line is what the market survey indicates investors expect for the inflation rate going forward. And also this rate can be interpolated using both US Treasury and Treasury inflation protected securities. So it's showing that, you know, over a 1 year period, we are looking at something just under 6% for inflation. On a longer term basis, the gold line shows what the median 3 year ahead inflation expected inflation rate is, and it's trending back toward the decade-long trend at about 2.5%. We've seen during the pandemic a rapid rise in commodity prices. A lot of this is oil, as people came back to working and driving and doing things like that. It's also been exacerbated by the logistics problem that the pandemic has created with shipping and transportation. You may recall in 2021, we had astronomical increases in lumber and building materials. A lot of these things are starting to abate as the overall economic activity in the country starts to slow and house construction starts to decline. Here you're seeing what it looks like for oil and oil inventories. The price of oil is the blue line. We saw a rapid increase in 2021 and the first half of 2022, and a subsequent decline recently as demand has started to abate, number one, and number two, as we've seen inventory come down with the releasing of oil from the Strategic Petroleum Reserve. Oil has also further been impacted by the Russian invasion of Ukraine and the impact on the European markets. Well, the US dollar is astronomically strong. Why? The reason is that US rates have risen faster than in any other country, making this the place to put your money so you can invest in these high-yielding treasury securities.
Time to go to Europe.
Pardon me?
It's time to go to Europe.
Time to go to Europe. Yeah, the dollar is at par to the euro. And everybody that we know that's been has said, yeah, it's really cheap to travel. Everybody looks back, you know, we market participants tend to be like military generals leading troops into the desert wearing jungle boots and back into the jungle wearing desert boots. We always fight the last battle. And so you've seen a lot of prognosticators saying, oh, this is going to be worse than the financial crisis. We don't think so. During the financial crisis, households had very increased debt service to income ratios. And we've seen that fall post the financial crisis as the excessive leverage in the overall economy has come down. And most recently, we saw it fall precipitously during the pandemic, largely because of the fiscal stimulus that government basically handed out to get the economy back on track. So we don't see a real debt problem within US households. And I will, at this point, then hand it over to Steve to talk about interest rates and fixed income markets.
Thanks, Brooks. So this chart looks at the US Treasury yield curve. The curve gives us a snapshot of where bond market rates are for varying maturities at a single point in time. So the data we're looking at here is a comparison of where rates were at the beginning of the year, represented by the blue line, and then where rates are today, represented by the gold line. If we take, just for example, pull the 10-year, if you look at the two-year Treasury on the blue line, interest rates at the beginning of the year were less than 1%. Now that 2-year Treasury is yielding well over 4%. So we've seen a significant increase in rates across the curve, primarily due to the Fed's fight against higher inflation. Now, the Fed can control or has influence on the short end of the curve. So as they've been increasing rates, the shorter maturities have responded, but the longer end of the curve is really influenced by market forces. So it's an indication of where the market thinks both inflation and economic growth will be in future years. I'll also point out the shape of the curve has been a strong leading indicator of future economic growth. And during normal economic times, we see a more, we call a normal slope, where the slope is from left to right and longer bonds yield more than shorter bonds. But there are times when the shape of the curve will deviate, which is really a signal that there's a potential turning point in the economy. So when the Fed starts tightening aggressively, as they've done now, it's not unusual to see the longer term rates start to lag behind, which is an indication that the economy or the market does believe the economy will start to slow, and we may see lower inflation. And when that happens, we get what's called an inverted yield curve. So why is that important? If we look at the next slide, Brooks talked about the year-over-year job growth numbers being a recession indicator. The other indicator the market watches closely is this relationship between the 2- and 10-year treasuries. And the reason for that is, if from a historical context, yield curve has inverted before every recession since World War II. So when investors are expecting weaker growth, they expect lower inflation, and they start to think that the Fed will start cutting rates, that spread between the 2 and the 10s starts to narrow. And when that relationship falls below 0, which if we look on this chart, the blue line is now has gone negative, that's been an indication that a recession is on the horizon. So today, that 2-10 relationship is about, the chart shows about 45 basis points. As of this morning, it was about 39 basis points. But at that level, it's something we haven't seen in a while. So it's a strong indication that we are in a recession or headed for one very shortly. We recently passed a milestone in the US as our federal debt levels rose to the highest levels on record. We now have debt levels that are above $31 trillion, which has surpassed the debt to GDP levels we experienced back during World War II, when the country was borrowing huge amounts of money to fund the war effort. So this trend is troubling, but if we compare US debt levels to Japan's current debt levels, which is represented by the gold line on this chart, our debt levels are nowhere near Japan's. So yes, the trend is concerning, but what we think is more troubling in the short term is the question of how the government's going to service these current debt loads. So it's estimated the cost to make interest payments on US debt could jump from roughly 400 billion to almost 580 billion during this fiscal year. So that's about a 45% increase. And this will ultimately put constraint on government spending, and we think will lead to debates about where future money is going to be allocated, and is it going to be allocated or spent on defense or social programs. For a long time leading up to the financial crisis in 2008, the Federal Reserve's balance sheet was less than $1 trillion. And if you recall, in 2008, Federal Reserve instituted quantitative easing to help bail out our banking system. And as a result, the Fed's balance sheet went from 1 trillion to 2 trillion, and then additional stimulus packages were announced, and the balance sheet ballooned to over 4 trillion by 2017. In 2018, the Fed announced it would start reducing its balance sheet, but then the pandemic hit and the balance sheet expanded to over $9 trillion as the Fed was infusing liquidity into the markets. Earlier this year, the Fed began quantitative tightening again, which means they're allowing the treasuries and the mortgage-backed securities that they purchased to mature and roll off the balance sheet. Now, the Fed, they came out and said they were going to reduce their holdings by as much as $95 billion a month. But so far, based on our calculations, the average monthly reduction has been closer to $28 billion. And if you think about what the Fed is trying to do, they're walking at this tightrope here, because in order to reduce their balance sheet, it means they can no longer be a buyer in the market, where when they're a buyer, they provide lots of liquidity. Now at the same time, they're trying to reduce their balance sheet, which means pulling liquidity out of the market. But at the same time, they don't want to cause a dysfunctional market. So it's a big challenge for the Fed at the moment. This graph shows the Fed funds target rate over the last 20 years. And if you look at the current rate cycle we're in, the Fed has raised its benchmark from 0 to 3% so far this year, and the market's pricing in an additional 1.5% of rate hikes. So the market expects at the next Fed meeting in November, we'll potentially get a 75 basis point or 0.75% increase. And then it looks like the market is also expecting another 0.75% increase in December. So if both of those happen, we'll be nearing a 4.5% Fed funds rate by year end. It's also worth noting on this chart, though, that the market is already starting to price in the Fed having to cut rates beginning in in late 2023 and early 24. So the market's looking at the rapid rate hikes we've seen so far and is thinking that we're either going to end up in a recession, or we may see some type of financial problem that the Fed's going to have to come in and bail us out, similar to what's going on in the UK right now. So these expectations can shift, but that's where we are right now. It can be argued that the Fed was late to its tightening cycle. And in hindsight, probably should have started raising rates sometime last year, but it's made up for lost time so far. If you look at this chart, the initial rate hike started in March, and on a rate of change basis, it's been one of the fastest rate hike cycles in modern history. And because there's a lag to monetary policy anywhere from 6 to 24 months, the impact of those rate hikes that started in March are just now starting to be felt through the economy. One of the tools the Fed has is coordinated moral suasion. So there have been numerous comments from various Fed officials with almost the exact same language, that they've come out and said, we're going to raise and hold, and we're not going to pivot too early. And we've seen this almost after every Fed meeting. Fed governors, they hit their speaking circuit and they'll talk about what's going on in the markets. But lately they've ratcheted this up. And if you look at some of the quotes since the last meeting, really from almost every voting member of the FOMC, they've all basically been saying the same things. And we think this is really due to what happened. If you go back to March and April when they started the first two rate hikes, the market really wasn't getting the message clearly, or wasn't understanding what the Fed was trying to do, because the stock market would rally after the rate hike. So now what the Fed is trying to do is send a clear message that they're not going to pivot until inflation comes down. And as Chairman Powell said, they're going to try to inflict some pain in the market. Brooks referenced this. This chart is very similar to the strong dollar, but we've seen Treasury yields surge around the world as inflation has picked up in most developed countries. If you recall from our presentation last year, we were talking about negative yields, and well, that environment has certainly reversed course. So foreign central banks they're trying to prevent their currencies from falling. So their central banks are trying to keep pace with what the Fed is doing here, and has created this global tightening cycle and created higher yields around the world. One of the metrics that we watch are high yield debt spreads. So high yield, or also referred to as junk bond spreads, have been a good indicator of how smaller or more risky companies are doing during times of high market volatility. The high yield bond spread it's the difference between the average yield of these lower quality companies in US Treasuries. So for example, if junk bonds are yielding 9% and treasuries are yielding 4%, this would equate to a spread of approximately 5%, which is where we are today based on this chart. We've increased our exposures to US Treasuries in our bond portfolios because we believe they still offer the best risk-adjusted value when the economy is slowing. But as we've seen during prior downturns in the market, like the financial crisis in 2008, where spreads rose as high as 20%, and then most recently in the pandemic, they backed up to about 10%. The market can present these good buying opportunities in the high yield market when liquidity dries up. So we'll continue to monitor this sector and determine when or if it's appropriate to add exposure to our portfolios, but we just don't think we're there yet. We think there is still more room for spreads to widen. And with that, I'm going to hand it over to Evan, who's going to talk about some of the changes we're making in our portfolios.
Thanks, Steve. It was a relatively light trading quarter for us, and it's not that we haven't been active this year. In fact, actually, much of the action we took was done in the first half of the year, selling some of the pandemic winners in our portfolio, like DocuSign and Chewy, and then becoming more value oriented with companies in consumer staples and energy. We continued that trend into this quarter. We increased our exposure to VPU, which is the Vanguard Utilities Index Fund, to bring us to a market weight in utilities, which are really stable cash flow companies. Utilities have perpetual demand, so they've got pricing power. Similarly, utilities, or the VPU, offers over 3% dividend. We sold a healthcare company called Progeny, which was a really interesting company that offered fertility benefits and a wide network of fertility specialists, which we bought on the idea that as more and more families are delaying having kids, this would become even more important. But the decision on Roe v. Wade, which is going to force Progeny to implement their policy on a state-by-state basis, made that much more challenging. So we sold that and we bought a position in Merck, which is a big pharma company. Big pharma companies tend to be value oriented. Merck has been extremely successful with some of their cancer treatment drugs. They also have a vaccine division, so we decided to park our money there. It also pays an over 3% dividend. So in conclusion, the stock market decline has meant that valuations have declined significantly to much more reasonable levels. And we're actually now below the 25-year average of 16 when looking at the forward price to earnings ratio on the S&P. Inflation is high and it's been sticky, but there are some signs that it may have peaked. Similarly, the labor market remains tight, but we're also seeing some signs of softening there. The Fed is fighting inflation both with rate hikes and moral suasion, and they said that they're going to remain data dependent, but they can reduce their balance sheet more aggressively if they would like to screw down the hatches on inflation even more. So within our portfolio, we've pivoted to more value-oriented names that pay higher dividends, which should increase portfolio income. So thank you. From there, we're going to open it up to questions. So if you have any questions, you can click the Q&A at the bottom there. All right, we're getting a couple rolling through here. The first one is, bear market time span has averaged about 10 months overall. Pundits say this decline started in June 2022. Would you consider getting back into the market within the next 6 months for those clients that have cash, expecting the market to rise by the end of next year? Brooks, do you want to take that one?
I think that's a reasonable question, and the answer is most likely. The question will be, do we see more in the way of activity coming out of Russia? That's going to be the great unknown. And does that further disrupt what will be at that point then an emerging recovery? So I think that's impossible to predict. how that's going to go, and we'll have to, if anything, delay and wait a little bit further until we see some sort of resolution there.
Okay, great. So another question here is, have we seen peak inflation? Darcy, do you want to handle that one?
No, just kidding. Yeah. I think we have. I think that there are plenty of signs that we highlighted through the presentation, you know, oil rolling over, housing costs rolling over. You know, I think there's a question of, have we seen the peak? I think yes, I can answer that probably pretty confidently. What I'm less confident on is how quickly it comes back down from the stratosphere where it currently is. You know, Brooks spent a lot of time talking about the shelter CPI because, as he pointed out, that's basically a third of the weight in the CPI calculation. So I also think that that's really, really important. And we don't have this chart in the presentation, but you know, offline, we've looked at the rental prices of rent versus home prices versus that owner's equivalent shelter CPI component. And there's generally about a 9 to 12 month lag, both on the way up and on the way down. And we actually, this was part of our second quarter 2021 comments, was that, you know, shelter CPI hasn't risen. And that's why the Fed was saying, don't worry, this is all transitory. And we said, but we're kind of going, but rents and home prices have risen. So it's that delay that happens. So it takes about 9 to 12 months, but given that we are starting to see rent and home prices roll over, I do think shelter CPI will start to roll over as well, and that will pull down the overall inflation number.
Okay, thanks, Darcy. So we got a question about year-to-date performance numbers for each of the portfolio types that we offer. And you know, I'll try to answer this question here. I think that you know, each portfolio looks slightly different. Because each of our clients have different risk return parameters that we're managing towards. And so some portfolios may have more fixed income exposure or more equity exposure. Within the fixed income or equity, the portfolios tend to look very similar though. And so the way that we manage our portfolios is about 85% is going to be made up of mostly large cap US companies, which is going to look and perform very similar to the S&P 500. And then we add another 15% exposure in international and small cap companies, which provide a little bit of diversification. As we looked at the beginning of this presentation, international stocks have underperformed, so that has been a slight drag on performance. But you know, you can expect the portfolio performance to be similar to the S&P 500.
I would just add to that, Evan. Oh, sorry to jump on your toes. I'll just make one comment on the fixed income, because I think that's an area where we've really done a much better job than the index. So when I went through the asset class returns, it was 10 to 12% declines for those major bond market indices. I think because we've stayed very short duration on the fixed income side, and built these treasury ladders for many of our clients, the fixed income returns are nowhere near that much of a decline. There is a decline, but it's maybe less than 1%. So I think that's where we've had a different type of return than the benchmark index, which is positive.
And adding to that discussion, most advisors ascribe to the paper that was written in the early 90s by a guy named Brian Sullivan as a CFA at Vanguard. And what he recommended at that point in time was that investors should be globally indexed to the market cap of the total world equity markets. That came about after a 4-year period in which international markets just crushed the US market. For those of you that are old enough like I am, recall the late 80s, every car you saw on the road was a Datsun or a Nissan, and the Japanese were buying Rockefeller Center and Pebble Beach, etc. Well, In the aftermath of that, the recommendation came out that we all ought to index, and that the indexation towards international would have portfolios between 35 and 45% international. We, for a decade, have been, or more than a decade, have been below 10%, so very much lower. That's worked to our advantage. One of the changes that are likely to occur as we go forward and come out of this bear market is that we'll increase our allocations to international and do that both through ETFs as well as American depository receipts. We have some of those in portfolios now, companies like Diageo or Shell.
All right, thank you. Looks like we got a question here about wars that was probably a follow-on question. Need a little bit more context to answer that one. And then, do you anticipate as much volatility in the market in 2023? Steve, do you want to take that one?
Yeah, sure. So actually going back to the wars question, if it was just simply how do wars impact the markets, markets tend to actually shrug off wars, and obviously wars take a tremendous devastating human toll on populations. But if you look at some of the worst periods of war, even here, World War I, World War II, stock market returns tend to be positive, and primarily because governments are spending on defense, and that tends to be good for the economy. And then the second one, do we expect more volatility in the markets in 2023? We hope not. Certainly, given the volatility we've seen so far, there are a number of hurdles that we're looking at. The near-term one is midterm elections, right? So the market doesn't like uncertainty. In any time there is a question about where how voters are going to, or how many voters are going to turn out, and where the elections were going to go, that tends to add to that level of uncertainty. So we think getting past the midterm elections, whether the Democrats remain in control or the Republicans take over, it really doesn't matter. It's just getting through that and having that information. So I think when Darcy talked about right now, the market is really focused on what the Fed is doing. If we get to the end of the rate cycle where the Fed is no longer raising rates and the market starts to just focus on earnings, we think that will decrease the overall volatility of the equity markets.
All right, thanks, Steve. Another question here. How would you rate the different sectors today, for example, tech, healthcare, utilities, etc., in terms of overweight, neutral, and underweight? How might these ratings change in 6 to 9 months? Darcy, do you want to take this one?
Yeah, were you at our research meeting last week, or this is exactly the question that we're asking, I think. In terms of how we're weighted today, we are underweight technology. We are underweight pretty dramatically in consumer discretionary. We are overweight consumer staples, overweight in materials, and that is mostly because we have a couple of gold mining stocks, which I will cover separately. So, and we overweight energy, staples, underweight technology. Yeah, I think that covers it mostly. We're kind of roughly in line, maybe a slight hair over underweight in the other sectors, but those are, I think, the major places we differ from the S&P 500 exposure. The investment in gold miners, I just want to explain, because the way that we started looking at the markets at the beginning, and the inflation at the beginning of the year, was the Fed can really kind of go a couple different directions here. Inflation is here and it's bad. So the Fed can get out, they're late, but they can get out and get aggressive with it and bring it under control. Or they could be, what they refer to as dovish, which is the Fed wants the market to do okay, so they're going to back off and not be too aggressive with rate hikes. It really was a major concern of ours, and I think there's still a little bit of concern that the Fed might go that dovish route and let inflation spiral out of control. That was what we saw as really a worst case scenario. We are happy that the Fed has increased rates to the degree that they have and tightened monetary conditions, because the alternative really, I think, would take us to what we saw in the early 70s, where the Volcker Fed eventually had to step in and break the back of inflation. And at that point, they took interest rates from 10% to 20% within a year. That was really bad for the market. And really, that was the only way that the Fed was able to rein in that extremely high inflation during that time period. There are a lot of differences as to why I think that we're not going down that hyperinflation route, but on the off chance that the Fed backs off because they're afraid of causing a bear market, or they don't, they're influenced by political persuasion, whatever it is, we wanted to have some exposure to gold miners because gold has traditionally been a very, very good inflation hedge. Gold miners are also very cheap stocks that pay dividends. So that's kind of part of why that setup is there. As far as how these over or underweights might change in the next 6 months, or 6 to 9 months, I think that's a really good question. There's part of us that says, okay, well, we've tilted back to value, kind of tightened the belt across the exposure. Maybe it's time at the bottom to get back into those growth-oriented sectors. But if you look at a longer term performance chart of growth versus value, there are inflection points for growth. For the past 15 years has outperformed value, bar none. It's not even close. And is actually, growth is relatively more expensive relative to value, even at this point after the years, the chart that we saw with growth and value. But the times that we've seen inflection points and change in leadership is often at market bottoms. And I think there is a really good argument to say we've gone from a period of 15 years of zero interest rates to a period of non-zero interest rates. That might actually be a benefit to some of those value-oriented sectors. So it's an ongoing discussion. That's kind of, I think, how we're probably leaning towards sticking with that value for now, but that could change if the Fed starting to cut rates again.
Okay, thank you, Darcy. Got a philosophical question here. What does it take to have a managed portfolio beat the S&P? Seems increasingly hard to do given the composition of the indexes. Brooks, do you want to talk to that one?
Sure. The short answer is it's very difficult, and that's why we've stuck pretty close within the equity portfolios within the non-international, non-small cap part, what we call our core portfolio. Our focus is really to match what's going on, and if we can beat it, great. But then doing that with a portfolio of individual securities gives us the ability to manage gains and losses and to use highly appreciated assets to make charitable gifts, as an example, which you can't get if you're just in an S&P index fund. Additionally, I talked earlier about the question of how much international to have. Most investors use the MSCI World Index as the benchmark to beat, and we've done very, very well relative to that simply by having such a small exposure to international. That will change, much like Darcy talked about growth and value change of leadership. We anticipate that we're quite likely to see international take off coming out of the bear market down the road. Probably not developed international. At this juncture, it looks like the Western European markets are going to have a hard time with all that's going on with energy in Ukraine, et cetera. So it's likely to be more emerging market kinds of things. And I think there'll be some really good opportunities coming forward at that point.
All right, thank you, Brooks. And it looks like that is all we have for questions for today as we approach the end of our hour. So I just wanted to thank everybody for coming and joining us for a great presentation. Hopefully you took something away from it. If something comes to mind after the presentation, feel free to reach out to one of the relationship managers here. We'd be happy to have a discussion with you.
Thanks, everyone.